The end of the financial year is upon us, so a quick update on the last 12 months, as well as the outlook for stock markets, interest rates and the Aussie dollar for the next financial year, and some suggestions for business conditions as we reach the halfway mark for 2017. We've mentioned a few times in recent updates that our stock market index has been lagging the US and European stocks, but overall it was a pretty solid 12 months, with the ASX 200 up over 10% even before dividends, which might be surprising news given it was 1 year ago we had the shock Brexit vote and about 8 months ago the equally unexpected US presidential victory for Donald Trump. But some of the positives that have emerged since then include less concerns around China's economy and hard landing risks there, better outcomes in Europe, both economically and politically, with wins for the moderates over the far right in Austria, the Netherlands and France, and locally, reasonable business confidence and jobs growth. More on the business outlook shortly. A year ago, the RBA cash rate was 1.75%, but was cut to a new record low of 1.5% in August, as inflation remained below target. But since then, term rates steadily rose through to March, as can be seen looking at the 3-year swap rate, as the Trump trade played out with its assumption of global reflation and with a better outlook in Europe. And even though this has unwound to a degree in April and May, longer-term rates do seem to have turned the corner. And it was interesting to hear ex-RBA board member John Edwards talk about the possibility of our Reserve Bank increasing official rates over the next 2 years, which will probably be dependent mainly on the inflation outlook. Overseas, the interest rate outlook is more clear. The US are continuing to tighten policy, and Canada and the European Central Bank are publicly flagging higher rates and removing stimulus. But now that the rest of the world is talking higher interest rates and not just the USA, the US dollar is starting to weaken. The Australian dollar, as a result of all of this, has firmed to the top end of its range, approaching 77 cents. In contrast to most forecasts, we have been calling the Aussie higher for some time on our expectation of a weakening US dollar, a Chinese soft landing, and our geopolitical stability, at least in relative terms. But equally, it has struggled to break higher through 78 cents as concerns linger regarding housing and household debt, and the shrinking interest rate differentials with the US in particular. The latest rally, as iron ore prices have reclaimed US $60 per tonne, may well see us through the 78 cent barrier at last. Overall, as we embark on a new financial year, we observe a jobs market that has momentum, business confidence at above trend levels, and highly accommodative interest rates and exchange rates. Perhaps the missing link is consumer confidence and retail sales, which is where the outlook for housing is so important, given its link to consumer spending. Our observation here is that while housing prices are growing less aggressively than had been the case, which is welcome news, equally the more dramatic suggestions of a sharp fall appear overstated, which is why we expect business confidence and business conditions can remain at above average levels. And while New South Wales and Victoria had been leading this confidence, we're starting to see the mining states bridge the gap, and more broadly based improvements by industry, in line with the impressive sharp rise in full-time jobs in May and the latest population growth data. So all the ingredients of further growth in the economy, but still the dependence on China, our housing market and low interest rates, for as long as the RBA can afford to keep them low. And that's the market update from Bendigo Bank.